Hi, my name is Cesar De La Cerda. I'm a financial advisor and I'm the founder of EnvisionVest. How well do you understand where and how your money, your investments, or assets are located? What about how or why they should be located a certain way? It really only matters when it comes time to pay taxes on your investments. This is the why of how your investments should be positioned so that they can maintain a more optimum tax efficiency. I would love to share with you some information about asset location and understanding the difference between a qualified and non-qualified account. Many of you are familiar with the notion of asset allocation. Basically, it's a method of allocating investments by a certain portion or a percentage of your investments. The investments are portioned like a pie. Asset location is an important concept to understand in terms of how an asset will be taxed. Having an understanding can help improve efficiency of your asset's performance in terms of the tax treatment for gains or losses. How much of your investment pie do you want to keep? Do you want to share your investment pie with people you don't know? I hope you're thinking to yourself that you want to keep as much of your investment pie as possible. Your investments, whether it's in real estate, mutual funds, ETFs, stocks, or cryptocurrency, can be taxed at some point. Having a strategy to understanding the positioning of your investments should be top of mind to help you protect your hard-earned money. As a foundation, understanding how investments are looked at by the tax regulators or even creditors to an extent involves its titled placement. Investments can be located in either one of two forms, qualified or non-qualified. Let's take a look at non-qualified first. This could be any asset that you own, such as real estate, stocks, that don't necessarily receive any special tax treatment. It can be pretty plain vanilla. Think of a bank account such as a checking or savings account that you own. Maybe real estate holdings, investments that you purchase through an exchange or brokerage account. Look at these types of investments as something that you purchased with money that you earned and pay taxes on. The tax part comes in if there is an increase or even a decrease in the value of that asset. How an asset is taxed depends on several factors, such as for how long you've owned it, before you sold it. Depending on the asset, there are a multitude of things to consider, such as the cost basis, depreciation, or tax laws that change how some investments are treated. Let's look at qualified investments. These are types of investments that receive special tax treatment. The growth of these type of accounts are considered tax deferred, meaning that they get taxed later in most cases. These type of accounts are generally creditor protected. Think of retirement accounts. As an example, an employer retirement account, 401k, simple IRA, or a SEP. Individuals can open individual retirement accounts that can also receive the special treatment. Think of IRAs, Roth IRAs, 529 college savings plans, to name a few. There are several other type of accounts that also receive this special tax treatment. These type of accounts are generally in insurance type products such as annuities. In closing, your investments can be held in any of these two types of accounts or classifications, if you would, which is the why an asset allocation strategy is important. How your investments are treated for tax purposes matter if you want to keep more of your investment pie to yourself or for those that matter to you most. If this stuff seems confusing and could use some help, schedule a complimentary consultation and I'd love to help you out. Thanks for chiming in, and if you made it this way, please like us, subscribe, and share this content with friends and family. And remember, always keep your money working for you all day, every day. Thank you.